Here we're going to be looking at a lease with an unguaranteed residual value. So we're going to concentrate on this unguaranteed residual value here. So if Corporation P purchases the machine here on 11X1 for $11,700, and on the same date they lease it here to Corporation S on 11X1 with 3 rental payments of $4,000 per year at the beginning of each period, at the beginning of each year, and there's going to be unguaranteed residual value of $2,000. So in this case, because we have this unguaranteed residual value, the lessee and the lessor are going to have separate debt amortization schedules here. So first looking at the leaser here with the unguaranteed residual value here. So for their debt amortization schedule here, looking at the payments, they would have included here the 3 payments of $4,000, plus they also have to include this $2,000 unguaranteed residual value here at the end of the lease. So taking the present value of these amounts and discounting them back, in this case it was at a 16% interest rate, we'd have a machine cost here of $11,700, and then there was a payment made here at the start of the lease here, $4,000. So we have a balance here of $7,700 here that has to be amortized. So let's look at the journal entries here for Corporation P. In this case it was a parent leasing a piece of equipment here to Corporation S, the subsidiary. So for our journal entries here, as a separate company here for Corporation P on 20X1, on the lease date here of 11X1, they'd have a lease payment receivable of $8,000 here. Those would be the 2 payments here that they're going to receive. They've already received the first payment of $4,000, but it'll be the next 2 payments of $4,000 here for a lease payment receivable for minimum lease payment here of $8,000. And then they would also debit or include the unguaranteed residual value here for $2,000, and then they received $4,000 here in cash that would be debited too. And then for our unearned income here, that they'd record that at $2,296. Going up to our amortization schedule here, that would be the total interest payments that they would be receiving on those leases. See, they got 3 interest payments here totaling $2,296. And then they'd have an accounts payable here credited for $7,700, and that was the balance that was due on this lease that we calculated here. And then at the end of the year 12/31/X1, they'd have a debit amount here to the unearned interest income here of $1,232. That was the interest here for the first period. And then they'd have interest income credit amount here of $1,232. Okay, now looking at Corporation S, the lessee's journal entries here for at the inception of the lease here. So now Corporation S, or the lessee, would have to have a different debt amortization schedule, and their amortization schedule would include these $4,000 payments that they're making here on this lease, but it would not include that $2,000 unguaranteed residual value here. So discounting these $4,000 payments back here using that 16% interest, discounting it back to the start of the lease here, they're worth $10,420. So going up here, that present value here would be $10,420 for the lease, and subtracting out this first payment of $4,000 gives us a balance here of $6,420. That's the amount that has to be amortized on the lease here from the lessee's debt amortization schedule, because they have a different schedule here to work off than the lessor's debt amortization schedule. So looking at our journal entries here for Corporation S on 20X1. So on 11X1, they have assets under capital lease here for $10,420. That would be debited here, and that is the present value here that we calculated on those 3 payments of $4,000 each. And then they would credit obligations here for capital lease of $6,420. That's the balance that's remaining here on the lease here. And then they made a cash payment here, credit that for $4,000. And then on 12/31/X1, they have an interest expense here of $1,027. That comes off our amortization schedule here for the first on 1x2 here they have that interest expense, and then they have an interest payable here of a credit amount for $1,027, and then they also would be recording the depreciation expense here of $3,473. Now this depreciation expense, that's based off the present value of those lease payments here of $10,420 divided by, in this case there's 3 years on this lease, using a straight line we get $3,473 per year here for these for that depreciation expense here, and then accumulated depreciation here would be credited for $3,473, that first year's depreciation. Okay, now we're going to be looking at any eliminations and adjustments that we'd have to make here on a consolidation between Corp P and Corp S here for this lease here, and we're going to be looking at the unguaranteed residual value here. So all the eliminations and adjustments would come directly off those separate debt amortization schedules here for Corp P and Corp S that we just went through, except for the two above that we're going to be looking at here. So first here for our depreciation expense here of $240, we'd have an adjustment here to depreciation by that amount, and that's based here on the lessee's cost of $10,420 that we calculated, and then the depreciable cost here was $11,700. That was Corp P's cost here on this lease, and then we'd have to subtract out the residual value here, or the salvage value that would be called of $2,000 here for the unguaranteed residual value here, and that would give us $9,700 here, and then netting that against the lessee's cost here of $10,420, we get a decreased depreciation expense here of $720. So we'd have to adjust that we'd have to decrease our depreciation expense here because the parent had $9,700 and the lessee here had a greater cost here of $10,420. So that gives us that $720. And then we have 3 years on this lease here, so divide that 720 by 3, you get $240 here. So the next adjustment we'd have to make here is to this unearned income here. And for the Corp P, they'd have $1,064. That came directly off their amortization schedule here, Corp P's amortization schedule here for the last 2 years of this interest that they would be receiving here. And then we have to debit $1,269 here, and that would be that remaining interest here, a receivable, or that would be due here of $1,064, plus it includes $205 here, and that's based on the difference here between the lessor's income of $1,232 plus and then the interest expense here for the lessee or corporation S here of $1,027. So the difference between those two here gives us $205. So we'd have to include that here. That $1,269 would be the $1,064 plus this $205 gives us $1,269, and that would be debited here. And then the credit adjustment here would be $205, and that was simply the difference here between the interest income here for the lessor or corporation P and the interest expense here for the lessee or corporation S here. And those would be the those are the two main adjustments that we'd have to calculate here. The other adjustments to eliminate the debt and interest payable and any for any intercorporation debt and payable and interest expense and revenue, and then we'd have to reclassify this lease here as an asset from a leased asset to a productive asset, and those would be coming. Most of those adjustments would be coming off these separate debt amortization schedules. But we just concentrate on these two here that had to be calculated because of this unguaranteed residual value.